Good morning, everyone. There we go. And good afternoon to some of those online. Welcome back. Thank you for being here with us today. I think that intro video really set the foundation for us because we are grounded in conviction, I believe that. Fantastic results, awards, all of that. And celebrating a big milestone in October last year of 10 years on the North American class, which is a very exciting accomplishment. So congratulations.
Thank you, Kat. Thank you for that kind introduction. I'm super happy to be here. Nice to see everyone.
Great. We have a full 35 minutes together to talk about all things Darren and his mandates. And we're going to kick things off with the North American equity class, as we touched on. It has been a tremendous success for you, for your style, for your process. So just walk us through, how have you achieved such consistent returns within that mandate that really demonstrate your style?
Yeah, thank you for that question. So my style is to invest in high quality companies. So when I invest in a company, I'm looking for three things. One, is this a high quality business? Do they have a high or rising return on invested capital? Do they have a durable competitive advantage? Two, management. As part of our investment process, we interview all the management teams before we invest and during the investment period. What are we looking for? We're looking for management teams that have alignment with us as shareholders. So ideally, they own a ton of shares. You want them going to bed at night thinking about how do they grow the share price? How do they grow the intrinsic value per share? You don't want them going to bed at night thinking about just growing the size of the company to grow their paycheck, right? Two, we're looking at capital allocation. How do they invest the excess free cash flow of the company? Ideally, for me, I want them to give it back to us, return it to us as shareholders through share buybacks is usually the what I'm looking for. And then the third thing is valuation. Is this a great business at a fair price? What's the free cash flow yield? Generally, when I think about returns, Kat, I'm trying to underwrite to a forward return of greater than 15% a year. So how do I do that? I think over long periods of time, share prices track the growth in free cash flow per share. So we model that out for the next several years. We look really far, usually farther than Wall Street, which is kind of 1 to 2 years ahead. So how is that? What's the algorithm for free cash flow per share growth? And then I think about the multiple that it's trading at. Can it sustain this multiple over time? Or even better, is it a cheap stock where maybe it can even increase its multiple, although I'm a little more reluctant to underwrite higher multiples into the investment case.
With that 15% being that key number there. So lots of data layered in that foundation, which is an exceptional process that you've laid out. I think what's also very unique about your process is you spent some time in private equity prior to joining Fidelity. And so you really have that ownership mindset, right? And you talk a lot about how you view these companies as being an owner. Speak to us a little bit more about that.
Yeah, sure. Well, by the way, I like the 15 because it's really good compounding math. Because if you think about compounding, that's how you make money over time in stocks, right? You own a good stock or a good fund that can compound for a high rate of return over time. So 15% after 5 years is a double, after 10 years is a quadruple. So that's why I like the 15.
Those are pretty good numbers.
That's why I like the 15, yeah. And so in terms of the ownership mindset, so yeah, in terms of the investment process, I want to think like an owner. So not like someone who owns a stock for the next quarter, but someone who's a minority owner in a business. I think that means it changes the way you select companies, it changes the way you manage your fund. I have more of a concentrated fund. Typically, I own between 40 to 50 stocks, and the top 10 are usually between 40 to 50% of the fund. I think that in order to have superior results, superior defined as high absolute returns, higher than peers and higher than the benchmark, you need to, number one, have good ideas, and number two, you got to make sure you own a lot of those good ideas so that you can really benefit from them. Yeah.
Great. So I'm just picking out all these key numbers. 40 to 50 stocks is primarily what your portfolios will look like, with the top 10 being 40 to 50% of allocation. So really important numbers there. Let's touch on the geographical flexibility that you have. We are based in the US currently. We live in Canada. You get to toggle back and forth. Talk to us about how you play that flexibility within the fund structure.
Yeah, sure. So I run multiple funds. I think your question's about the Fidelity North American equity class.
Yes.
Okay. Yeah. And so that fund, the long-term target structure, there's a lot of flexibilities you mentioned, but the long-term target structure is 70% US, and typically I tend to be larger cap stocks, and 30% Canada. don't think of that as 30% of a Canadian fund. Just think of that as me owning the best ideas that I can find in Canada, and it usually should comprise about 30% of the fund. There's a lot of flexibility, as you mentioned. The US can go down to 50% or up to 100%, and Canada can go up to 50%, and I can have up to 20% global.
Okay, great. So lots of flexibility on all spectrums. And North American Equity Class isn't actually your only mandate. You have two others. You took over the American Equity Fund and ETF January 5th this year, which is an exciting new hobby, endeavor, challenge, whatever you want to call it for you. And then you also co-manage the Global Natural Resources Fund with Joe Overdevest. So we'll dive into both, but maybe just talk to us about the American Equity Fund since it is, I'd say, your new baby right now.
That's right, a new baby. Okay.
Yeah. Your new child.
Okay. Number 3, I guess. And then, so you took that fund over on January 5th. And so I've run the Fidelity North American Equity Fund for more than 10 years, as you mentioned. And so I like looking at 10-year performance because you can kind of see like over long periods of time, like different market cycles and different styles. How did someone do? But if we deconstruct the performance, the U.S. did a lot better than that fund average and higher than the S&P 500. So I want to apply that same style and process that I have in the North American fund in the U.S. equity fund. And so it should look very similar to the U.S. portion of Fidelity North American Equity Fund.
Great, so a bit more concentrated on the focus. Excellent. You have always been very clear around the fact that you're a bottom-up stock picker. You don't pay a ton of attention to what's happening in the macro environment. However, there is just so much happening. You need to be market aware as to what's going on. So just talk to us about the current macroeconomic conditions. What are you seeing in these times of volatility, and how do you approach that?
Yeah, I think the way that you characterized my viewpoint and the importance of macro is probably very fair. So I would say that you're right. It has been a volatile year, but it has been a good year. And so overall, I would say that I'm positive, I'm bullish. And look, I get that there are several challenges, but where am I focused? I am focused on bottom-up company fundamentals. And those are right now fantastic. So in terms of company earnings, we are in earnings season. We're probably more than halfway through it in the U.S. Company earnings have been very strong. They're up around 20% this year over the prior year, which is very strong. And they've also been revised up since the beginning of the year. I think it's about 9%. Usually in a typical year, analysts are very optimistic at the beginning of the year, and slowly during the year, those estimates get revised down as we see reality. But this year, reality's been better, and it's been revised up. So that makes me bullish. Overall in the economy, I think the economy is resilient. Clearly, Iran and the conflict in the Middle East and high near-term oil prices does represent a challenge. My view is that over time that it will de-escalate. It will de-escalate. I do think the U.S. political cycle does matter. It is complicated. It seems like a bit of a stalemate at the moment, but I think it'll de-escalate. And if we look at the Fed Atlanta GDP now, the estimate for Q2 is like 3.5%. So it shows that the economy is pretty resilient. Earnings have been very strong and revised up. And just generally, in terms of sectors, like where am I optimistic? Where am I looking? Where am I hunting? I'd say technology and communications. We can group them. Industrials. And financials. Okay,
we're going to dive into all of those because there's a lot to unpack. So we've set a really strong foundation of the data that you look at. You couple that with being market aware, bullish. It sounds like on what's happening in the environment. So your best ideas. You just mentioned technology. Let's start with technology. AI. We'd be remiss if we didn't talk about AI. What's your view on the potential runway in that area?
Yeah, I'm bullish on AI, and I think in terms of technology, I think this year is different than past years. I think in past years you can say, hey, I'm bullish on AI, I'm bullish on tech, and you could broadly own tech and do well. I think now we're seeing a bifurcation within tech. Where are we seeing that? We're seeing it within the compute and the buyers of compute and maybe the companies that are impacted by compute. So what do I mean by that? So the sectors that provide compute, so semiconductors and computer hardware, as well you can say within industrials, the names that supply power. to data centers. All these names have done really well as there's been a huge insatiable demand for AI. We can see that last week, right? We saw like the hyperscalers, right? Like they reported, and we saw like Google, which is a top 10 position of mine, Amazon also in the top 10, Meta and Microsoft reported, and we could see for the cloud business, the bookings were up like massively in the quarter. We could also see like revenue and margins being revised up, but you could also see capex being revised up, and capex being revised up is where one of the markets focus, and you actually, as a result, you saw like a mixed investor reaction to those, but it's very like with Google trading up a lot, Meta down, and then kind of Amazon a little positive and Microsoft in the middle, but it's very positive for the compute supply chain as capex is being increased, and all four of them talked about very, very strong demand and a desire to continue growing compute and internal demand for compute.
Okay, so maybe just as a segue to that, software has gotten beaten up a little bit. Obviously, we've seen positive earnings come out, but software versus hardware in the sense of where you're focusing your attention.
Yeah, so I'm more focused on semiconductors and hardware than software. I think software has been tagged with this this tagline of death from AI, and it's just kind of hard to refute. But within software, I do have some ownership. I do own Shopify. That's in the top 10. I've owned it for a long time. I really like the business. They've done a great job in terms of growing the gross merchandise value and kind of slowly adding to their solution. So they've done really well. And I think also because it's not like a seat-based software company. Instead, it's really as a percent of payments, and it powers the e-commerce and revenue for these companies. I feel very good about it.
Okay.
So I own that one, but generally I'm very underweight software, and I'm more focused on the compute, which is in semiconductors, hardware, and data centers.
Excellent. You mentioned industrials. Do you look at industrials as a derivative or a way to play the AI chain? And maybe dive into what areas in the industrial sector are catching your attention.
Yeah, sure. So yes, partly yes, but not fully. And so what are the areas I'm interested in within industrial? So I think one is data centers. So data centers is seeing like unprecedented growth, right? We're seeing massive growth in bookings. And so where are we seeing that in the industrial? So number one, the construction stocks, engineering and construction stocks in the US, also in Canada. In Canada, it's less to do with data centers and more to do with sort of nation building projects and other sort of mega projects. We're seeing that in the US too, mega projects. And then I'd say two in the machinery stocks. And so the machinery stocks, so think like big yellow, massive equipment stocks, that's benefiting from data centers, but it's also benefiting from construction. It's also benefiting from resources. So we are seeing a lot of activity and demand in the industrial economy, which is benefiting these stocks. And I'd also say the third area is in aerospace, and that's probably lesser weight in my portfolio than it would have been in years past. It's been a really strong contributor over the past 4 years, the aerospace stocks, and I've also shifted a little bit from owning the companies that are more focused on the aftermarket, which is companies like servicing planes that are in the current fleet, versus having exposure to the OEMs like Boeing and Airbus, supplying them parts, the new planes. And I kind of think there's a little bit more upside there as the aftermarket stocks have done extremely well.
Take us a layer deeper. Why the aerospace? Like, what's the thesis for aerospace?
So generally, I think aerospace is the highest quality area to invest in industrials because of two reasons. One, secular demand, right, for air travel. More people want to travel. And so as a result, you got to build planes. The OEMs have been like terrible investments, right? Like Boeing and Airbus, although better recently, mind you, because they've had a lot of challenges with regulation, safety, unions, balance sheets. But the parts and service suppliers, especially the ones that have been focused on the aftermarkets, have done really well. And so here, it's a second reason why they're high quality. You have very, very sticky demand and high margins. And let's also think back to Warren Buffett when you invest, right? Warren Buffett said, like, own a monopoly. You'll make a lot of money over time. And so these are like sneaky monopolies because these parts are regulated by the FAA. And so you can't have just any competition on them. So they tend to have very high margins.
Excellent. At the beginning of our session, we talked about financials. You had mentioned financials at the top. We heard the global asset allocation team talk about how they are starting to overweight Canada, actually, and get more back into our homeland. What are you seeing in the financial space? I know you had some exciting meetings at the beginning of 2026. Talk to our advisors here today about your views on that. Yeah,
so we have a lot of meetings, and I find them really exciting. I mean, I like to...
I can tell you find them exciting. You light up.
It's one advantage of working at Fidelity is because we are a very large global active manager, all these companies, they want to talk to us. They want capital. They want to see Fidelity's name on the shareholder list. And so they come talk to us. And so not like we meet them at our office, on Zoom, at industry conferences, and we also host our own industry conferences, which are not available to the general sort of investing audience, which is a nice benefit for us. And so you're talking about financials. I think you're right. So we talked early in the year, and I was lucky enough to have a day to meet with all of the big six Canadian bank CEOs. So I think Canadian bank fundamentals are strong. We saw the U.S. banks report, and they had a really strong earnings. And so why is that? I think so net interest income is positive and growing. I think capital markets revenue is strong. I think the cost discipline is good, so they're showing margin gains. I think the credit is something that I want to keep my eye on and watch there very carefully. And I think they're returning a lot of capitals to shareholders. So the Canadian banks have done really well. CIBC has been the top bank. It's in my top 10 this year. So that's been great for the fund.
So the sentiment from the CEOs is relatively positive in what you're hearing.
Yes.
Excellent. Let's pivot a little bit. Let's talk about global natural resources. So you co-manage with Joe Overdevest, as some of you may know Joe as well. But we've been seeing a resource rally recently. Energy, I mean, you can't go anywhere without hearing about this in the news right now. Talk to us, though, about your views on just the resource sector, because it's not just energy, there's metals and other variants in there. So where's your perspective on all of that?
Yeah, so I've been running this fund for a long time, and since 2007, actually. And so with Joe Overdevest, you mentioned, Joe does the energies, does a great job, and I do the materials, metals, and mining side. And I used to be a materials, metals, and mining analyst for Fidelity in Boston during the super cycle in the mid-2000s, and I covered potash and copper mining, and so it was a lot of fun.
That was probably an exciting time.
It was a super exciting time. And so now we're in a bit of a resource boom now, so it's exciting again. But there was times at the low point of the cycle where people were like, "Oh, you covered that?" I'm like, "Well, actually, this was like the tech stocks of the 2000s, right?"
Is there any deja vu from what you experienced back then to what you're seeing today?
There is a little bit. And so where do we see that? You see that when commodity prices go high, part of the reason is it's a hard business. They're hard to produce. Where are we seeing that? We're seeing that in copper right now. So if you look at copper and you look at the 10 largest mines in the world, I think there's like 4 of those mines that are either not producing or are producing well below their nameplate capacity. And so that's due to mine expropriation. And I find like geopolitics becomes more complicated when commodity prices go high, by the way. And then 2, I think it's just difficult to keep producing at this level. And sadly, there's been a few mining accident disasters, which due to safety reasons, they need to produce at a lower rate and make sure that the mine is safe and also get the mine ready. So hard to produce, hard to bring on. Like, I mean, the other deja vu I can see is I remember in the mid-2000s, like I covered Teck Resources, and they bought a company called Ore Resources to get this mine, the QB2 mine, Quebrada Blanca, if I can try to pronounce that. And it only just came on. Like, it only just came on like last year, and it ramped up this year, and that was like 20 years ago.
My goodness.
So it shows you how hard it is to bring it on. So yeah, there's deja vu. Just let me wrap that up by saying I'm bullish on resources. I would kind of rank them in terms of gold, uranium, copper, and I will put them ahead of energy. Energy has done extremely well year to date. and in part because of the conflict and the lack of supply due to the Strait of Hormuz. But I think you're seeing oil prices very, very high, and I think that the returns from here will be a little harder to come by, just given prices are high.
That's fair. And we actually have a question from the audience. So you talked about, you just mentioned gold in your list there. Maybe dive a little bit more into the case for gold, because we saw it have a run last year. Do things remain in the sentiment, or have things tapered off?
Yeah, I like gold. I think that we saw gold do a big run up. We saw a pullback in March during the conflict. I think that the drivers of the gold rally before the conflict, I think, will remain intact. And so what are those? So I think it's three things, Kat. I think it's one, it's diversification away from the US dollar. We're seeing central banks, we're even seeing some new players like in the crypto world, and you're also seeing like family offices and retail moving away from US dollar treasuries and towards gold. Two, you're seeing around the world populist governments on both the left and the right have large budget deficits, high debt. I think that makes people attracted towards gold as a store of value versus fiat currencies. And then three, elevated geopolitical risks. It's clearly been a theme for the past 2 years. You
just mentioned geopolitical risk. That's obviously had an impact on the consumer. So let's talk about the consumer for a little bit here. How are you viewing that, and what is your take on the consumer space at this time?
Yeah, I think it's mixed. And so I came into the year wanting to get bullish on the consumer, because the consumer had been in a really sort of, I don't know if rough is the right word, but like, let's say a softer place. And I could see that the one big beautiful bill would elevate stimulus to the consumer in the form of higher tax refunds in the US.
Right.
And I was thinking that rates would come down. And I think the picture's a little different now. We have higher gasoline prices. You are getting that stimulus. The rate picture is a little more complicated. I think it probably will, but I'm not going to prognosticate on the Fed. I'll leave that to our GAA team. He does a great job. But I think for the consumer, it's mixed, right? And so like, let's think within consumer, what are the big buckets? So I think the biggest bucket is housing, right? And I think housing, it's complicated. Housing prices are coming down. Mortgage rates are still high in the US, and people are locked into lower mortgages. And so we're seeing like lower housing starts and very low housing transactions. And so I'm still a little cautious on that space. The autos, we had seen a depressed auto SAR, the number of autos produced in the U.S., and there's some incentives this year, but now you have higher gasoline prices, and for the parts suppliers, they're getting hit with some of the commodity inflation, so that's a little bit mixed. I think there's some interesting idiosyncratic ideas within consumer. I own Aritzia. I like retail. I like apparel. But you really have to do a lot of legwork to get the stocks right here, because not all of them are going to work, obviously. But what do I look for? I look for a brand that has a lot of pricing power because it's well known. I look for a story where they can roll out the stores either in Canada and the US or globally. And I'm trying to find ones that are at a great part of their growth curve.
Excellent. So we've talked about a lot of the things that you like and that you're looking at. Question in from the audience or from online. Are there any areas that you're maybe avoiding? So you did just touch on, housing, autos, and having, some skepticism perhaps there. But is there anything that's an absolute no in your process right now?
Nothing comes out as an absolute no, but I have touched on a few areas where I said that I'm becoming a little more cautious.
Yeah.
And so housing, autos. We also mentioned software before. And so other than that, I don't own anything in utilities. I have found that although there is a bit of a utilities renaissance because of there's great power demand again after many years without having that, I found the better way to play it has been through investing in industrials companies with leverage to building out that grid or supplying it. Yeah.
Okay, great. Company management is obviously, along with the data, the other big piece that you need to be comfortable with. You need to get to know, be a part of those meetings that you get so excited about, which is great to see. It's vital to your process. And just talk to me about maybe what are the things that get you excited about a management company, and what are perhaps detractors from you saying, I don't want to go anywhere near that management company, even though maybe the business on paper looks great?
Yeah, great question. And something I've thought a lot about. I was actually lucky enough that when I was an analyst and I started at Fidelity, we had this training that was provided by former CIA members, where they were trained interviewers teach us how to interview management teams, and so how to ask questions, how to interpret responses, both verbal and nonverbal. So I've thought a lot about it. But in terms of the management teams, I mentioned earlier that I do want to see alignment. Like, I want them to be really excited about growing the per share value of the company, and I want to feel like we're almost like in a partnership with them. In us as the owners and them as the management of the company. And so companies that are executing well, they own a lot of stock, and then in terms of capital allocation, they're investing that really well, either by buying back shares, increasing the dividend, or occasionally doing M&A that makes sense. It's in a related business, it's on strategy, they're buying it at a good price, it's accretive to earnings per share. What I don't like is management teams that are growing the size of the business just for the sake of growing the size of the business, right? They probably get paid more that way.
Right.
But I'd rather see them get paid through growing the share price. Two, management teams that do bad capital allocation. I've seen that. I've sold on this over the past couple of years. So there was a company that I owned in medtech earlier this year where they made an acquisition that was like a surprise. It didn't seem like a fit, and it made me worry that they were going to miss numbers on their two key products, and so I sold that. There was another company in consumer 2 years ago that was a producer of consumer durables for consumers, and they made an unrelated purchase, like very different business, and it made me think like, okay, I don't think this investment thesis is on track, and so I sold that one. Turned out to be like, it's not always the case, but oftentimes when you see a unrelated acquisition, it can be to diversify or change the narrative, and that's not what we want if we have a certain investment thesis. So, and then another one, sorry, I guess I'm excited on this, and is I track their insider like buying and selling, and I hate to see like management teams that they sell a lot before bad news. Then I don't feel like we're in a partnership, and my I don't know. I'm like trying to do the best by our unit holders, so that's where I'm focused. So
it's almost like dating, where you want to know what you're looking for, but also what you're not looking for, right? So when you see that misalignment, you need to be able to pinpoint that. You had mentioned earlier, and Patrice actually brought it up too, these unique consumer conferences that you do get access to. So there was one recently in Boston, a bunch of CEOs from a variety of companies on the consumer side. Maybe just talk about the setup of that event. I think it's just such an exclusive way that you and Fidelity get that inside scoop as to what management is thinking, what they're hearing, and really understanding the sentiment, right, of where the economy's at. So if you can just touch on that conference for us.
Yeah. So yeah, Patrice and I went. It was great. We were in a room with 8 other colleagues, and we met with the 20 CEOs of the 20 largest consumer companies in the U.S. So these are companies like Coke, Home Depot, Lowe's. And so that was fantastic. I think my takeaways was that the consumer would be more resilient than I would have thought to the higher gasoline prices, and that certain areas sounded really interesting and better than I maybe would have thought, like travel and leisure, and some areas sounded a little more challenging, like food and beverage. Excellent.
We have 2 minutes left. Let's maybe just talk about overall. So you have global natural resources, you have American equity, and you have North American equity. How do these fit into an investor's portfolio? Where do you see them playing a part with regards to the exposures?
Yeah, so for me, I've been running the Fidelity North American Equity Fund for a long time. I'm the largest shareholder of that fund. That's been a discretionary decision. And so for me, like that's like larger than my house. So that's my biggest asset. And so it's like, I find that fits well for a one-stop shop. It's for a Canadian investor, it's 70 US, 30 Canadian. I think if investors are more positive on the US, or if they want to have a fully like one benchmark fund, then Fidelity American Equity Fund makes sense. And I think Global Natural Resources is more of a specific play on resources. I also manage the equity portion of Fidelity Canadian Balance Fund, which is a more conservative fund. It's half equities, half bonds for Canadian investors.
Excellent. And I think you always put proof in the pudding in the sense that you are the largest personal holder of your mandate, which I think is excellent because you are invested as in the investor success and obviously indirectly yours as well. So Darren, thank you for being here today. Appreciate your time. We wish you all the best for the rest of 2026.
Thanks, Kat. Thanks, everyone.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.